Hello guys. So for today subject, we try to see how to grow your trading account faster, and I will give you some guidelines as usual. I'll try to explain as much as I can. Um, so what I say here is in general theory about steps to do and a lot of things and guidelines. But in our trading account, I do it in practice. So I will show you the theory, I show you the practice. For example, last year we have made 140% from January to I think November, and then I reset the account, and then we begin fresh. I think in beginning of December. Now today we are at 24th of January 2011. It means we have 2021. So we are at 45% profits in these 2 months, which is excellent. Although the market, you see, the market doesn't grow that fast, but we manage to make our account do better, way better than the market. It means Dow Jones or S&P 500, it does nothing, okay, compared to what we did. This is because of the things you should do in order to achieve these things. So hello Fabian, hello Bobby Six Killer, thank you very much for coming. You are always on time, thank you very much. Now to proceed with hello Empty Mirror, thank you very much for coming. So just to give you an idea how things work in a trading account. Now understand that there are many things that can make your account grow faster. Okay? But when we say faster, it means you should do more aggressive, risky trades. Okay? It means the more risky trades, the more your trading account can go faster. If you are doing less risky with a lot of positions, it means a lot of stocks in your account will be growing slower. But it will be growing. Since you know how to trade, it will be growing. But it's always better than Dow Jones, okay? So because Dow Jones last year, it collapsed and then it goes up. So I will, before we go further, let's see, for example, Dow Jones or S&P 500 or Russell 2000. These are the major indexes that the people look at. Mostly is S&P 500 and Dow Jones, okay? Because they represent the market. Now, S&P 500 is more representative because we have 5 biggest companies in America, 500. Okay, that's why. Hello, wise man. That's why this 500, it represents almost all the sectors. Okay? Some sectors are doing good, some sectors are doing bad, some sectors are average, some sectors are doing the same as the index, and all these stocks, you will see the index. So let's go. For me, I always see the Dow Jones, not the S&P 500, because Dow Jones has the 30 biggest companies in America. It means the juice of all stocks. It means the biggest companies. Now, the biggest companies, when they grow, they don't grow that fast, because they are big. Check, for example, any stock that it is in Dow Jones. But some stocks are better than other stocks. Some are very, very volatile. Now, why is that? It is because analysts are focused on these stocks. They talk too much about them. And you find a stock, a company, you find a lot of analysts in a lot of newspapers, magazines, journals, TV. Some we have YouTubers. It means, if you go to Facebook, it means, or Twitter, you will find a lot talking about this. So they give a lot of information, and the people, they get excited. Now, when they get excited, so the media, what they do, they push these people to buy that stock or to neglect that stock. Okay? So there is an influence of the media, and this I will speak about it in another live. So today we try just to see what makes your account going bigger and bigger. Okay? And if we take, for example, let me see, let me fix the thing. It goes so slow with the thing. Okay. So now we begin first with positions. Now I will tell you a guideline that you can use in your trading. The less companies in your account, it means bigger risk in your account. Now, when you have big risk in your account, either you can lose a lot of money very fast, or you can make a lot of money quicker. And there are some people who like excitement. They don't like stocks that go 1% or less than 1% or 2% a day, or they don't like this kind of stocks. So they don't want to see those stocks in their trading. That's why some people hello, Mini Cool, thank you very much for coming. So that's why some people go to stocks that are volatile. You can see, for example, some stocks move 5%, 10%. Now these stocks, some that are big, some that are small, because when we speak about stocks that move fast, we always think about penny stocks. But there are some bigger stocks that move like a penny stock. Okay? I'm not saying like a penny stock from $1 it goes to $5 or $10. No, because that is clear manipulation, and I have spoken about manipulation about penny stocks last week. So, but here I'm speaking about the movement of the stock itself. Now we take an example. For example, last year, take an example of Tesla. Guys, those who follow Tesla last year, okay? If you see how much Tesla has gone, you understand. You understand that this stock, like Tesla, is a monster. Now, what do you mean by a monster? It means when it moves up or down, because understand, that Tesla is a very risky stock. It's a dangerous stock. If you don't know how to handle this stock, you can lose a lot of money. I will show you an example right now. Because there is a split, I will use the chart and I will explain to you. Hello, Sabah, Salam, how are you? So let's go to chart. I see here Dow Jones. Okay. Let's give you Tesla first. Okay. Let's just take this stuff just to show you how things work. And from the beginning to the end. Okay. Okay. Now, if you look here, let me, if you take it up, just to make it clear. Now, look here. This is the end of February. Here, like 19 February 2020, last year, to 18 or 19 March. It means 1 month. Now we try to see how much this stock lost. Okay, it was 188. It goes to 70. 188. It goes to 70. Do you know how much you lose if you are, for example, holding the stock until when it goes down? 70 and 70 is 140. Okay? So you will be losing about 65% or 7%. I don't have the calculator to calculate the percentage you lost, but you lost about 60, 65 or 70% of your money. Now, if you don't know how to handle this stock, what if Tesla, you lost here 65% or 70%, and it continues to go down, to go down, to go down? Okay? You will be losing a lot. But suppose that you bought like us, like last year, we bought here, and you bought, for example, at 70, let's say here, at 70, at 85, $85. Now it is 1,846. You are making the 1,000%. 1,000%. This is what I talk about. Is high percentage. Okay? Now, high percentage. This stock is having high percentage, but either up or down. But up is way better than most of the stocks. Now, let's go back to the Dow Jones. So here we said from 85 to 846, it's about 1,000%. 1,000%, it means if you put $10,000, now you get $100,000. 10,000, $100,000. So you see? But if you want to do like this, stocks, you should be aware that if it goes down and you hold it, you can lose all your money. Okay? Now we compare Tesla, the same period, from here, from 19 March, when the market go down. We let's say you invest like other people invest, some people who invest in the indexes, ETF indexes. I don't like indexes except when they are industries. When they are industries, yes, they can go faster, but the general indexes they can't. So the Dow Jones, Okay? Now look at the Dow Jones. So here, the beginning, which is, let's take the nice, yes, 24, which is the beginning of the trend. We have 206. It goes now to 309. What does it mean? It means we have made 50%. So, 50% only. Now let's put this just to explain to you how faster are a stock. Now, we put here Tesla. So, 1,000%. 1,000%. It means if we take it as money, it means if you put 10, I'm sorry for this, 10K, how much you get? You get 100K. Is this real? Yes, it is real. But understand that before that, Tesla has lost, for example, 70% of your money. It means if you have 10,000, 10K, you are left with 3K only. Okay? So understand that there is a big risk in Tesla. Now we take, for example, Dow Jones, DIA, Dow Jones. Now you put 10,000. How much you make? You make $5,000, which is 50%. So you see that? So you see how you can make here $100,000, and here you have made $5,000 if you put all your money in. This is what the people they say. These stupid people, they say, "Oh, invest in indexes, and it is safer than the." Yes, it is safer, but you are not getting any money. Okay, you are not getting any money, and this is not what we are looking for. Okay, guys. Al Hassan Qasimi, good evening, Kareem. Nice to see you. Thank you very much for coming, Qasimi. Now, so you understand, guys, this is the first guideline I give you, is that there are volatile stocks. You can make a lot of money, but the bad side from this is they are volatile. You can lose a lot of money if you don't know how to handle them. How to handle them, it means when you are doing a trade, when you just begin to, this is I told to all my students, but some people, they can't believe they should get out with minimum loss. Okay? A trade, in general, is just a bet. Now, I will explain how the trade works. Okay? Again, I will just go and explain this. At least you have an idea. Okay? Now, let's say you have a stock that it is $100. This is the stock. You bought whatever shares. And let's say the stock is this. This is a candlestick. You see it's going up, or what is your strategy? I don't know what is strategy. So now here you buy. Okay? Now, here is the future. So the future, you don't know if it is good or bad. Okay? This is the future. Now you are here. You are today. Now the best guideline to see, you should put a line like this. This is $100. $100. You should have a stop loss a stop loss in your mind. A stop loss. It means what is your tolerance if the stock you bought it here at 100, it's going down. What price are you going to exit? Because this is a trade. Okay, it is a trade. It's not an investment. Now you are not, because you should understand. The first thing before you buy, is this an investment for 10 years or 20 years? You do fundamentals, you do the other thing. So we are not speaking about that. We are speaking about a trade. A trade is you bet on a stock according to your strategy. Now, even before you buy this stock, you should have an idea what is your risk. Your risk, you can use whatever means. It doesn't mean that you should put stop loss as physical. You put it in your broker. No, you can just watch it tomorrow, 9:30 or 2 o'clock, or you watch it and you see. But you have an idea here where to exit. What is your exit if things go wrong? Now, if the stock, the opposite side, this is my strategy, on the opposite side, if it's going up, you should never think about stop loss or to exit until the trend finishes. So I will do like this, okay? Just to have an idea. Then when you have an idea in your trades, for example, you bought here. This is the candlestick you bought it. It's 100. You put a line. This is the buy line. I always use it for my students when we are trading account. I put a line and I say this is the day where you bought, because this is the day here, like this. This is the day. I will show you the chart right now. This is the day. And the green is what? The green is the buy point that you bought the stock. Let's say you bought it at $100. Now, even before you buy at 100, you should think about what is the exit. Let's say you want a high risk. You said 90. I exit at 90. It means 10%. Just an example, okay? If you reached 10% loss, you exit. Okay, this is your exit plan. Now, understand that for us, like for my training, it's going up until it stops going up. When it's going down, I have strategy here to sell. So I will sell here. But the sell, I don't know what or when. So for me, I don't have what we call price target. There is no price target. Price target, it means you said, I have seen some people doing this, and they told me, we have studied from one guru in trading. When it is 10%, you exit. Wow, who tells you to exit at 10%? 10% is here, but you should sell here. Like for example, at Tesla, if you are looking for 10%. This is not, you will never make money because you stop yourself from making money. The market is giving you money, but you stop yourself. This is the biggest mistake you do in swing trading, is when you stop yourself. Especially when the trend is going. It's not done yet. It did not dry yet. Now, these I have techniques, and all my students who are with me, they know about these techniques when to exit. And I show them for some stocks. I say, okay, today or tomorrow, this is I think that the trend has dried up. It will not go no more. We should wait for a few days or whatever, and then I see. If it is time to exit, I exit. Okay? So there is no price target. This is used in day trading, not used in swing trading. Swing trading we don't have. You should not stop yourself when the market. If I ask you, someone each day gives you money, are you going to say to him, no, give me just 10%, give me just, let's say each day he gives you, just an example, okay? Someone each day comes with $100 and he gives it to you. And he tells you, oh, okay, do you have a target price that I will not stop giving you money? Oh, you say yes. When I reach $500, stop giving me money. This is what we call target price. You stop yourself. The market is giving you money. Why you stop? It means when you stop and the stock is going up. What does it mean? It means other traders are making money and you are a stupid person. You leave the money on the table. Check Tesla. Tesla is an example. It was 85, now it is, let's say, 844. Are you going to, after 10% at 100, from 85 to 100, and then you stop, and the stock goes to 844? Are you stupid? Are you stupid to do that? And you say to me, oh, I don't know how to do it. Yes, that's why I am here, to teach you how to stay longer and not to play with money. When the market gives you money, you should get the money because it is free money, because you work on it. Okay? Because you work on this money. I don't understand why the people are doing that. The market, they give them money and they refuse. Oh, they say, oh, I am scared the market will go down and this 10%. What is this 10% that you're looking for? If you have $10,000, let's say you put it in a stock and the stock goes 10%, which is 1,000 profit. Are you going to just take this 1,000 and you are happy and you go spend it? And the stock after 1 month or two, it goes to $20. Let's say from $10 to $20. From 10,000, then you see $20,000 in your account. Do you want money? Yes or no? If you agree you need money, so you should change your mindset. Change it, because if you stay with old stupid rules. With some gurus, I don't know, they don't trade. I'm telling you, there are hundreds, I see them online. They have big channels, okay? I see them. You know, they have a good marketing thing. I don't have a good marketing thing, that's why my channel doesn't grow that much. But for me, it doesn't matter. For me, I just want to have some or few students who I can teach, they can begin to make money, and that's it. And then they go and they do it by themselves. I'm not asking people to stay with me the whole life and holding secrets or holding how I trade. No, I would never do that. Okay. So since we are speaking about hello Herman. Hello, Rolf Buffman. Thank you very much all for coming. So, we said that the main thing is if you are buying ETFs. ETFs are slower than stocks. Why? Because an ETF, it is just representing an index. An index, what is it? An index is a collection of stocks. So at least I show you why your account, whatever account you have, if you are having ETFs or mutual funds or what is it called, the other one, bonds, you understand that your account should be growing slower. I give you an example right now. Because I understand, most of you you have investment, like 401k. Most of Americans here, companies, they offer this. But understand that 401k, they don't let you do stocks. And I always speak about 401k, although it is good for the people who don't want to take control of their money, because you don't know and you don't have time. And you say, okay, I'm just saving money, and the company is matching some money, which is good, but you don't understand that with the 401k, for example, is that the money that the company gives you, it is always taken by the mutual fund company, because there are fees. Even ETFs, we have fees. We have less than 1% each year, but there are fees. Mutual funds can go to 3 or 4%. For example, I just give you an example why your account it will not go faster, and you can I will tell you guys, okay, I will tell you guys to check if you have a 401k. Guys, go and check and see if if what I am saying is true or not. Okay, take an example of 401k. I just give you anyone who works for some companies, they give 401k. 401k, what is it? It means it is a pre-tax money. It means your money, it is not taxed yet. So they throw it here. Let's say, just an example, okay? Let's say you put $100 each paycheck. Let's say you have two weekly paycheck. So let's say you put $200. Okay. Some companies, they match 100%. Some they match 50%. This is a free money from your company. Let's say it is matching 100%. It is $200 they give you from. This is your contribution. This is your company. I don't know if you are working for a company. You should know how much they match. Okay, how much they match. Some they match 100%. For example, if you put $200, they give you $200. Now this, where it goes? Okay, this $400, okay, it's going to the 401k. Now each year there are fees. Let's say it's 3%. Let's say you have $100,000 in your account. So understand that 3%, $3,000 are always taken from your account each year. 3%. If your account is 200,000, they take 3%. It means they take $6,000 from your account, and there are other fees. If you want to see the fees, you should just go to your account and look for the fees. You find all the fees. There are other fees, not just fees, annual fees. There are other fees. Now, let's now speak about what is inside. What is inside this 401k? Why your 401k is slow? I will give you why. Okay? 401k, most, you find what? You find mutual funds. Okay? You find bonds. And you can find the warranties and the other stuff, whatever is you have. But now, mutual funds, they have fees. What about bonds? Bonds, for example, let's say you have 5%. And here you have 3% loss. Okay? So, most of the time, if you continue like this, your account will be growing like the Dow Jones. And what did we say about Dow Jones? From end of March 24, 2020, you understand that Dow Jones, I just explained to you that it has gone, let's say, 50%. Now this year is from the March, if you are trading. But if you are a 401k, this year you are not getting 50%. So I will just go and explain this with a chart. Okay. Now look at the chart. Here, this day is the end, is the beginning of this is 6. Let's see when the year began. Thursday. Okay, let's say this is the market of last year, the highest here. Now we are looking for the highest because the highest of the year of last year, what is it here? 295.87. 295. Now it is 309. How much you make? 5 plus 9, $14. So you do the calculation and you do how much you have made. $14. Okay? It's nearly $300. 14 you divide it by 3. So 4. Let's say it is 5%. Okay? So last year, if you are holding your account down, for example, your account like your 401k, if it is the same as Dow Jones, what does it mean? It means you have made around 5%. So this is what you make because the whole year last year. So we will see the beginning of this year. Okay. It was 305, so it is done. Now it is 305. It means you have made 10. 10 by 3. It is 3.3%. Okay. So let's say we go back to our thing. Let's say your 401k, if last year it has done 3%. Okay? 3%. From when we say 3%, it's the whole year of 2020. Now, here $2,095 is the end, is 31st December 2019. Now the whole 2000, the end of 2020 is 305. You see that? How much money you make? You make only about 3%, 3.33%. Okay? This is what you make last year. Is if your 401k is the same, nearly the same as Dow Jones. Now we have fees, 3%. It means your account has made zero growth. That's why you say to yourself, why my 401k doesn't grow? It's just because it's almost full of bonds and mutual funds. Mutual funds, what are they? Are they just a collection of stocks together? So I give you just an example. Just an example. You can go to your okay. For example, let's say we take an example, mutual fund. Any example, it doesn't matter what is this mutual fund. Okay, it depends. What are the stocks that are in your mutual funds? What are the stocks? Are the stocks very risky stocks? So this mutual fund will move faster and but for Wall Street guys and the big companies who hold mutual funds, they don't want risky. Okay? They want your account to grow slower like this, to grow, and they don't care about you are making too much money or you lose too much money. What they want is each year 3%. 3% each year. 3% each year. That's what they want. And this is why you have 401k. Now, if you ask for 1k, you ask the company, oh, okay, I want my money into stocks. I want to put into stocks. It's my money. I do whatever I want. Now, here is the deal. If you go to a 401k company, it's your company, and they give you the number of the broker who holds your 401k. And you call them and you say, okay, guys, I have $100,000. I want my money into stocks. I don't want mutual funds. Do they approve? No. Because if you put your money into stocks, from where do they get their fees? You understand why Wall Street is getting billions. When we say Wall Street, it's all these brokers, these things that they have no risk. You risk, but they don't risk anything. But they take the fees. But 3% from $4 billion or $10 billion in the stock market, 3%, it's a lot of money. Who gets this money? Brokers, market makers, the big rich, it's all mixed up. So that's why when you want to make your account going faster, they don't let you. So that's why if you want to grow a faster account, you should not do 401k. Or you put some money for retirement, for 401k. You put some money always, and you make your account like a trading account, either on Roth IRA, because you can take your money because it is taxed. Roth IRA is the best you put money in. If you don't know what is it, I have made videos. Guys, put Roth IRA in my YouTube channel. You understand better. So, you understand now that hello, fun. You understand now that if you have an idea to make money from your 401k or any other plan. There are a lot of plans, but it's the same. The company give you some money, and you do contribution each paycheck. There are a lot of plans, but 401k is the most known. That's why I always talk about it. Okay. Now, but there are some 401k. They can give you your company stock. They ask you if you want to buy, you can buy. Yes. You can do that, but if your company is good, like Tesla, if it is your Tesla, you are working for Tesla, man, you put 10,000, now it is 100,000. This is the company that you should work for. at least you will have tons of money. But if you are working for Walmart, for example, or this McDonald's, or I don't know, you are not expecting to get any money either from your paycheck or from your investment. You will be always poor. I'm telling you, except when you are executive or store manager, or you are having a lot of money. Okay? Now, we have spoken the reasons why your account goes slower. Another thing that your account will be slower is the kinds of stocks you are having. There are some stocks that move fast. I take an example, Tesla. But the problem, you should understand that stocks that go fast, when they go down, they go fast also. And I have given you an example of Tesla last year. At the end of March, the end of February, the end of March, 1 month, it goes about 70% down. So you should, if you are a trader, you should exit before, I know. But if you don't know how to exit, or you are scared, or you get paralyzed or handicapped because you see things, 10,000, just few weeks, and it becomes 30,000. So you say to yourself, I lost all my money. Yes, you can lose all your money. Okay. Now, another thing, as I told you before, I have explained this before, which is if you put more stocks, you have less risk, but you have less profits. Let's say you have $10,000. I just give you this example to show you. Okay? So I just give you one example to explain this. Okay. You have 10,000 here. Two guys. And we have 10,000 here. So this is trader number one, trader one. This is trader two. Now this guy, he put all his money in Tesla. He has $10,000. After 1 year, it is $10,000. It becomes 100,000 K. Okay? Let's say trader one is a low risk guy. He doesn't like to lose. When he loses little money, he's crying, and like these guys, low risk. Let's say he knows how to trade. Let's say he made 50%. Now, how many stocks? Let's say he has 10,000. He put 20 stocks. Now, when you put 20 stocks, your account should be growing slower. Let's say he make 5K, and at the end he has $15,000 in his account. 15,000, it means he begin with 10,000. At the end of the year, 15,000. Now this second guy, he is a high risk guy. You can do one stock or two or three, which is high risk. So he put 10,000, he has 100,000. Now which one do you prefer? Are you with high risk or are you with low risk? Now if you don't, your psychology, it means you don't like to lose a lot of money, so you have low risk, so you should go with trader one. If you are like this guy, you go here. But for me, I am in the middle. For me, I am here, I'm in the middle. I like high risk stocks, but I put more stocks, but they are high risk. So if I lose 10% here and I make 20% in the other stock, so I am making 10% here very easily. So this is what I do. I am always in the middle. Okay, so you should choose what you want to do in your trade, in your account. And this, guys, this is your money. This is your money. You do whatever you want with your money. But I'm here. I'm just showing you how to go faster and how to go slower. Another thing, penny stocks, you should always put a lot of stocks. Why? It's not because you want low risk. No, because they are very volatile. Okay? It means a stock. I will show you now. I will take you to some stocks just to see, like penny stocks. So I will just show you from the thing. I show you. Let's say we go to the what's this? Yes, this is biotechnology. Okay. This is biotechnology industry. Now let's go to penny stocks and see how they move. Now this is 1%. This is none. I will just try to show you. So see, just 3 cents. It is 4%. Just 3 cents. So I will see. Now 6 cents here for this stock is 7.79%. You see how this stock is moving faster. Why? Because it's penny stock. Now look here. The stock was 43 cents. 43 cents in 31st of December. So today is 24, like 22. So 22 days from 40 cents, it goes to 82. It means 100% in this 22 days. If we take 2 days, 6 days for the weekend and holiday, it could be 16 days or 15 days. In 15 days, you make 100%. You see how much money you can make with penny stocks? That's why a lot of people they like them. But understand that you can get 100%. You double your money. Let's say you have $1,000. You put it in this stock, and after 15 days or 16 days, you get 100%. You double your money. That's why you say, "Oh, it's easy." But understand that this stock can also go down and have a problem. So see this stock. So here it was 25 cents. It goes to 83, 300%. Okay? So you see that these stocks are moving faster. Okay? But when they go down, for example here, 260, it goes to 2. It's a lot of money lost in one day. Okay? That's why I told you, if you are going to do these stocks, you should be careful. Okay? Now, so as I told you, penny stocks and IPOs are the most volatile, with some stocks in the stock market. Now, there are some people who are going to OTC, which is over the counter. All my students, I suggest to them, so I don't control my students. I say, man, stay away from the OTC. Okay? because the OTC or they are called pink sheets or so. You can make a lot of money with these stocks, but you can lose it all if something happened. So that's why I tell my students, you should stick with penny stocks that are in the exchanges, in the Nasdaq, in the New York Exchange, and American Exchange. Three big, the biggest, especially New York Exchange and Nasdaq. And the other American exchange is all about ETFs and mutual funds and the other stuff. But you can find stocks that are cents if you want to. In this week's, I am using penny stocks under $10 because I want smaller and smaller, and they show my students how to find these stocks and how to manage them and how to follow them. Okay? But they are very, very risky, so you should get accustomed with risky trades. So don't put money. I have some students who like penny stocks, and they take my strategies to do penny stocks. Okay? But they are very risky. Sometimes they make a lot of money, sometimes they don't. Sometimes they lose some money because of that. So you should be aware of what you are doing. It is not only penny stocks that are volatile. Some bigger stocks, Tesla is an example. In 1 month it goes 70%. So you should put this in mind, that it is not only penny stocks that are volatile. No, there are a lot of penny stocks. There are a lot of common stocks that are big, but they are risky also because they go fast, up or down. Or also, I can speak about IPOs. IPOs, I like them. There are some gold nuggets. When they move so fast. Okay? So sometimes we buy this gold nuggets like Zoom. Last year and the other year, I think when it comes to the market, just 1 week or two, I search, I find it. I don't know even what is it. I told you the story. Someone tells me, you are crazy. You are crazy. You don't know even the company you are trading. I say, no, I don't care. Now this is the story. At the beginning of this company, it moves 5, 10, 20% a day. Now when I just look at it, I bought it. And I bought it in our trading account. Okay? And it's written ZM. But for me, I don't know that it is the company that makes you can make a conference call with video. I don't know. I say ZM. That's it for me. Now when I finish the trade, I don't know how much I made. I made, I think, 70% or 80%. Just a few days or 1 week or two. I don't stay that long. And then I say, what's this ZM? And I look, I find it is Zoom. Zoom, I know it. I didn't use it that much, but I know Zoom. So I don't know even what is this ZM. That's why for me, guys, I am not interested in what the company name. Or when I see it, for example, when you see the company, I see what is its sector, what is in this industry. So for example, just to see what I see in general. Okay? For example, okay, AGEN. Now when I look at the name, Agenius Inc. This is the drug, is the sector. Biotechnology is the industry that this company belongs to. Okay? So, always you find stocks like this. Okay. You find stocks like this, and this is Jazz. Now, when you look at Jazz, J-A-Z-Z, you think that it's a company about jazz. They make music or they make instruments. But when you say Jazz Pharmaceuticals, you understand that it is biotechnology company. It is not about jazz. So for me, I see only this. I see only the ticker or the symbol. I find the stock, it's called, I think, WW, I don't know what's this, I think W2, or I have no idea what's Weight Watcher. I think okay, let's take this Weight Watcher. Okay. Now, WW, I don't know what is this W mean. Although I see it's Weight Watchers Inc. International Diversified Services and Personal Services. But when I look at the chart, I am looking at the chart itself. I'm looking at the chart. I see that it is WW if I want to buy it, but what I am interested in is the chart. Not what is this company, what does it do, or I go online and I begin searching, oh, what this company is doing, because for me, guys, oh, yes, WW, I think it's E. Let's see if I find it. Because I bought one like this. Ah, yes. Thank you very much. Yes. Thank you very much, guy. Okay. I will show you. Bobby 6 Killer. Yes. Thank you very much, because this is the company WWE. Now, I will show it to you. I thought before, when you say WWE, as you can imagine, I thought it's about history. It's a museum, or it's a history company that making books about history, or I don't know, or it is a research company about history. When I see WW, or it is the World War II, or World War One. This is the ideas I get, but I don't see that it is World Wrestling Entertainment about wrestling. Now I bought it before. I don't know which year. Yes, it could be. I will show you which year. It could be here, guys. It could be I bought it here in this area here. 10, 20, this is a monthly, okay? Monthly, until it goes until 97. So it was 21, it goes to 97, I think in 1 year or so. So I bought it in this. And then it collapsed, it's collapsing. So this is a monthly, okay? So, this is the example I really bought. Thank you very much, Bobby 6 Killer. WWF, no, this is not. Let's see again. I don't know. Maybe I bought it before, but WWF. No, there is no WWF. It doesn't exist. Okay. Oh, it was the WWF, and they changed it to WWE. I have no idea, but I am sure it begins with WW. I am very sure, because I thought it was like a history company or World War II or some company that does research about history, and I thought about World War II or one or something like that. But I was astonished. I was surprised that it is wrestling. Wrestling. We know all wrestling. So I have a question, because I have finished my live. So I have a question with Harman. What is the difference between common outstanding shares and float shares? Now, let's see here. Now, the common shares the company has issued to the public that are available to investors for trade. So I give you the definition of Investopedia, and then I will explain. It says the term float refers to the regular shares a common has issued to the public that are available for investors to trade. This figure is derived by taking a company's outstanding shares and subtracting any restricted stock, which is stock that it is under some sort of sale. Okay, in general, I will explain this. This is very simple. Herman is very simple. Float shares, this is the shares that are available for the public, for us. Now, when we say common shares, it is all the shares, even the ones that are restricted, or that are preferred, or they have some kind of restriction. They don't sell it. Okay, but for us, Herman, for us, the most important thing you should think about is that the float, or what you see in the exchange. If you are buying Facebook, for example, you are buying the float. It means shares available for the public. But there are some shares that are called preferred shares of Facebook. We have two. I think this is called Class A and Class B. It is for the people who have a lot of money in the company. Let's say someone who has 10 million shares of Facebook, for example. Now, this guy, he put too much money in one stock, in one company. That's why he wants some reassuring thing that Facebook, if it collapses, if they sell the company later when it collapses, let's say it go bankruptcy or it collapse, if they sell what is left in the company, like the buildings that Facebook in, or whatever they have as properties. If they have some properties, or they have some buildings, or they have whatever assets they have. So when they sell, they begin with the preferred shares. But it doesn't mean that you get all your money. Most of the time, when it is bankrupt, it's when you go bankrupt, when you buy a stock and you go bankrupt for this float or common shares, what they say, the normal shares, it's over for you. They took all your money, and they will give you no penny. Why? They give it all to the preferred shares. You understand? The preferred shares, they have the advantage. But guys, in general, try to understand that the company doesn't go bankrupt in one day or one night, and the next morning Facebook they say, oh, we are going bankrupt. No, bankruptcy stays many years. You see that the company is going down, and one day it collapses and it disappears from the when the ticker is taken from the exchange. It means it is bankrupt. But they don't tell you before. Oh, next week we go bankrupt. No, it comes as a surprise. But you understand, if you are holding a company that it is losing money, be careful. No one, because you have signed the papers when you are in the broker, you understand that when you apply for the broker, they send you some paper to sign. These papers, it means, it says to you, all your investment can be lost, so don't sue us. So you understand? You can't sue anyone because the company you want to sue doesn't exist. Where do you sue? Who will you sue? For example, you sue the CEO. The CEO is not the company. He is working for the company, but he is not the company. He has no relation with the company. You can't sue him. Okay? So and even if you sue him, he has no money. He said, oh, the company lost all the money. You can't go after him for his money and you ask him, because even if they go after him, they can't get nothing, because we have billions of dollars get lost. So you understand that if you lose your money, it's your problem. So that's why you are an investor. You should look for your investment and don't play the fool and just buy and leave. Okay? Thank you very much, Herman, for your question. Wiseman said they changed the name because it was similar to something else. Okay, thank you very much for the information. If I remember right, a charity had a similar name, so they changed it. World Life Federation. Oh, okay. Yes, thank you, Bobby. Thanks you, Karim, for the explanation. Okay, guys, if you want to invest, please invest in a solid company. Okay, don't go to a company that it is losing money. Especially, I'm telling you the truth, man. If a stock is going down and a company you don't know what is it, and you are just, they tell you, try to invest because this company next year will be. I say, no, man, I'm not going. This in Wall Street, it is called, what is it called? I think it's called holding a cutting knife. You know, when the stock is going down, you should just leave it going down. Don't be connected to like these companies. I have a lot of people during these years. They send me emails. They say to me, I have a company. It is $2. It's going down. Should I hold? I say, what is your company called? Okay, he gave me the ticker. I check. This company was $100. I say, man, do you imagine? This company was $100. Today is $2, and you are asking me to hold? These are crazy people. I don't know which books or which guys they learn from, but they will go bankrupt, these guys, because they don't learn. Okay? And this is and education is one of the most important thing in financial thing. You should educate yourself. You should understand what you are doing, what you are buying. At least you have an idea what's going on. Yes, you say don't try and catch a falling knife. Yes, thank you very much, wise man. This is let's say, a Wall Street adage, or an example, or idiom, or whatever. It means when the stock is going down, do not hold. You just exit and leave. But if there is a trend, they say a trend is your friend. You should not leave your friend. You should be with him because he's going good and he's giving you money. Okay? So guys, our account, I think beginning of December, it was 0. We begin from 0. 22nd, it means last Friday, our account is at 45%. This is a good thing for this year. We are making money, and the stocks that we bought, we hold them for long. I have some stocks with like 1 month and a half or 2, or some they have 2 weeks, some they have 1 week. So guys who want to join us or to follow what stocks I buy, what stocks I hold, you can just do silver if you don't want golden. If you don't want some lessons about investing, about the thing, you just go and get silver. If you want only stocks, penny stocks, or stocks to choose, you just go and do basic. You just find how to search what are the good stocks. Especially these days, we are doing penny stocks. Okay? So guys, if you don't have any question, I should close this live, and I should meet you next week if God wills. And be careful of the market. We don't know what's going on. It seems normal until now. There is no problem in the market. It didn't go down. There is no big correction. There is nothing. But we should just wait. Anonymous, thank you very much, Anonymous, for coming. It's a long time I haven't seen your name. Did you guys see the price action on GME? I saw with my own eyes. Option paid for $1,000, $500,000. So I don't understand what you say about 1,000. It's $500,000. So please, Anonymous, can you give me some explanation? You have my email. It's in my video. Any video or this video, you find my email. Send me this information that you have, and I will discuss with you this by email, because I don't know. I don't know about it. Yes, I know it is something that you noticed. But what is this trade in GME? If it is options, so when did he buy an option? What's the strike? What was the price? You should give me information. At least I see what's going on. Oh yes, I know you are just saying, but for me, what you say is very important. So I should discuss it with you. You don't just notice something and then you forget about it. You should see what's going on. If it is a good thing, what is the good thing in it, and can I do it? Yes or no? If you have $1,000, it goes to $500,000. Oh man, yes, I can give you 1,000. Give me $500,000 in 1 month. I give you 1 year. Give me in 1 year $500,000. But you see, 60 strikes. GameStop, it popped up 5% out of nowhere. But 5% is just little. 75%. GME, I have this is stock I haven't seen for a long time. Oh, let me see. Oh yeah, I see. Yes, but when it pop 75%, when you say $1,000, so is it out of the money? But I don't think 1,000 can go to 500,000. It's a lot. It's a lot. Yes, I know it's Friday, but how it goes? Oh, okay. But yes, if someone has bought maybe out of the money, okay, out of the money, options like call options out of the money. Yes, it might be. By the form, guys, I don't know which. Yes, in this. Yes, manipulation. I talk a lot about manipulation. Yes, there is a lot of manipulations, but we can find these manipulations at early stage, and this is where you find penny stocks or other stocks. Even if it's not penny stocks, you can find them. But if you want risk, you find this easily in my strategies. It's easy to find this, but understand that the risk is big. The risk is big. In one day, it can go 90% down, and you can lose all your money. So understand that there is risk. If you like risk, my strategies, you will find these stocks without knowing any manipulation, because it is known. Because you can go to this GME and you see the first day, the second day, it's going up. Third day, fourth day, you can find them easily by my strategies. Okay? So guys, thank you very much for watching. Anyone who has a question, please, my email is always there. I have another thing, guys, to let you know. I have my Facebook page. Guys, those who wants to send me a Facebook page, Facebook message by Messenger, not from my. So you can always contact me directly. Okay, this is my Facebook page. You can just send me a message if it is quick or you need help very quick. Okay, I give it to my students. My students always they send me sometimes when it is very, very important information or they want my help very, very quick. Most of the time, yes. You say, can I find this with a stock screener? Yes, but you should know the criteria. And when you know the criteria that I use, because you take a stock screener, it has hundreds of criteria. Which criteria do you use? And then, for me, I have all the criteria to see the stocks if they have a potential to go up, yes or no. And this is what we do in our search for each week. Each week on Friday, I make my search, especially penny stocks. I show them where are the stocks that you find them with criteria. Then I put them into my chart and I go through them all, and I will tell you which is better and which is not good at all. Don't buy it. Okay? And then next week we try to see the results. We can find 50% in 1 week, 100%, 200%. We find always we find these stocks. But as I told you, it's a risky thing, penny stocks. So you should be prepared to have risk. Okay? So thank you very much, guys, and see you next week.